Okay, hello. Welcome back to another Friday Live. Okay, today I'll be doing an earnings review of both Netflix and Tesla, who reported earnings this week. So yeah, both companies reported very different fortunes in earnings. So let's take a look at their performance. Oops. Okay, as you can see from the screen, after earnings report, Netflix actually tests share price actually soared by over 14.2%. However, for Tesla, it decreased by 12.1%. So in this slide, I'll be looking at both these earnings for both these companies and also do a full analysis of both companies. Okay, so let's start with Netflix first. So Netflix reported earnings for Q4 revenue-wise was about 8.8 billion, which was about 300 million more than third quarter. And then year-on-year growth was 12.5%, and operating margin for Q4 was 16.9%. So in terms of the full year FY23 results, if you look at Netflix trend over the years, we can see that their revenue increased by from 15.8 billion in 2018 to 33.7 billion in 2023. And in terms of gross profit and operating profit, there were also increases from 2018 to 2023. However, if you look at free cash flow wise, you will see that there is quite sporadic over the past 5 years. You can see that there was negative cash flow for 2018, 2019, and also for 2021. However, for 2023, free cash flow came in at 6.9 billion. So if you look at the trend over the past 5 years, right, in terms of compounded annual growth rate, for revenue-wise, 5-year compounded annual growth rate came in at 28.2%, while gross profit was 24.5%, and then operating profit was 44.3% over the past 5 years. Net profit-wise, this figure here of 45.4% increase was from 2020 when it was positive till 2023. So it's a compounded annual growth rate of about 3 years. So all in all, in terms of trend-wise, it was quite impressive for Netflix. So if you're wondering why is cash flow actually, there were some decreases in 2018, 2019, and then also in 2021, this is because for Netflix, right, a lot of their cash for the year, let me just bring my highlighter here. Where's my mouse? Hold on. Okay, you will see that a lot of their cash is spent on additions to content assets. So basically, this means that Netflix actually pay an upfront fee to actually buy content assets to be put on their streaming platform. So the content assets refers to things like movie rights, series rights, IPs in relation to certain content. Okay, so that's why you see that a lot of his cash is used in this purchase of content assets. So that is why in some years there were negative free cash flow because there was a very high upfront cost to buying content assets. So yeah, so moving forward, let me just double check. Okay, they expect even more lumpiness in year-to-year free cash flow progression. And then for 2024, which is this year, they are expected to spend up to 17 billion in terms of purchase for content assets. So if you compare to last year, 2023, 17 billion as compared to 12 billion is about a 40% increase in cash used in content assets purchase. Okay, so if you break Netflix revenue down into geographical segments, you will see that a lot of it comes from USA and Canada. They contributed 44.1% for 2023. And then for the past 5 years, has always been about 50%. So in terms of trend-wise, let me just remove this. Okay, in terms of trend-wise, USA and Canada past 5-year trend was 15.8%, but the most growth actually came from Asia Pacific regions, which is about 41.2%. But if a big picture prospect, Asia Pacific regions, their contribution to revenue is not very big, and only about 11% for 2023. So if you look at the whole 2023 as a whole, you will see that most of the revenue comes from USA and Canada, and also Europe, Middle East, and Africa. Okay, so if you look at Netflix memberships number, after all, their revenue is very much based on the amount of subscribers they have to their platform. So in terms of number of paid memberships ending for 2023, it came in at 260.3 million. And then a bulk of it comes from Europe, Middle East, and Africa, and also USA and Canada. In terms of trend-wise for the past 5 years, their total paid memberships actually increased by 16.9%. But then if you look at USA and Canada, the increase in total paid memberships is actually not a lot. It's only about 5.5% growth rate. The most significant one was Europe, Middle East, and Africa, or 23.8%. So although Asia Pacific region, their paid memberships grew by 43.8%, their contributions in terms of numbers wise is still not as significant as Europe, Middle East, and Africa. So in terms of net memberships, meaning the total amount, the total increase in membership numbers as called after deduction of those that unsubscribe or unsubscribe, yeah. So you will see that for USA and Canada, the numbers are not huge. It's only 5.8 million in net membership increases for 2023. In terms of total number, it came in at 29.5 million for the whole of 2023. So if you look at the past 5 years basis wise, total paid membership addition is not a lot, only at 0.8%. And then for USA and Canada, they actually experienced a decrease in the growth trend over the past 5 years for total paid net memberships additions. So yeah, so the most also, as per other segments, the most came from Asia Pacific. But then once again, their proportion of membership additions is not very big, at only 7.3 million out of the 29.5. Most of it came from, once again, Europe, Middle East, and Africa, of 12.1 million for 2023. In terms of growth rate, it's not very high, only at 0.6% over the past 5 years. So if you look into average monthly revenue per paying membership, meaning to say that the average revenue generated from each subscriber that Netflix has. Okay, there's no figures for 2023 for total number because it was not reviewed in their earnings report. But then they did review for each segment, for each geographical segment, what was the monthly revenue for that particular segment. So you see across the past 5 years, once again, USA and Canada contributed the most, followed by Europe, Middle East, and Africa. But if you look at the trend-wise, right, their total average monthly revenue for the past 5 years only increased by at a compounded annual growth rate of 5.7%, while USA Canada was 10%, which was not too bad. But there was only marginal increases for both Europe, Middle East, and Africa, and so for Latin America. So yeah, as you can see, Asia Pacific, they actually experienced a negative compounded annual growth rate of monthly revenue per paying membership. As you can see, it decreased from $9.33 in 2018 to $7.64 in 2023. So if you compare margins wise, right, you will see that over the past 5 years, Netflix has actually improved its margins in both its gross margins, operating margins, and net margins, from 36.9% in 2018 to 41.5% in 2023 for gross margin, and then a 50% increase from 2018 to 2023 for operating margin, and then another more than 50% increase in net margin from 2018 to 2023. So if you compare in terms of cost of revenue and operating expenses over the past 5 years, you will see that it's been increasing over the past 5 years. This is not surprising, given that there will always be more operating expenses per year due to staff costs and whatnots. And then, as I mentioned earlier, Netflix actually buys content assets. So over the years, this number will also continue to be increasing. So in terms of rate of increase for both of these expenses, cost of revenue increased by 18.6%, and then operating expenses increased by 13.7% over a span of 5 years. So to break it down into the individual expenses segment, a lot of it is down to marketing for Netflix at about 37.7% for 2023. Okay, technology and development is basically their production staff. So their filming production staff. And then general administrative is basically their corporate staff and back-end staff costs. So over the past 5 years, compounded annual growth rate-wise, increases for marketing is not the highest. It's actually the lowest among the three expenses segment. It really increased by 2.9% over the past 5 years, but the most came from tech and development and also general administrative. So this is basically down to increased staff costs and increased number of employees that Netflix actually has in both of these departments. So in terms of financial metrics wise, for Netflix, their current ratio remains above 1 for 2023. It was a slight decrease from 2022, mainly down to lesser cash on hand. So if you look into, so for Netflix wise, right, when they calculate their content, their current liabilities, there's this term called deferred revenue. So basically, deferred revenue basically means that it's just prepaid memberships that has not been fully redeemed. But then they expect this amount to actually be recognized over the next 1 year or so. So if you look at 2023 wise, you will see that under Netflix current liabilities, there's a deferred revenue of about 1.4 billion. So this will actually affect its calculation of its current ratio, because although this is under liabilities, it can be recognized as revenue in the next 1 year. Okay. So in terms of debt to equity percentage, this is where I'm a bit more concerned about Netflix financial footing, because if you look at its debt ratios, right, although it's been decreasing over the past 5 years, about 70% of its current equity is still being funded by debt, about 70.6% in actual fact. So look into it. Okay, so ignore the one on top, because it's already matured. So this whole thing was actually taken from Netflix 2022 annual report. You will see that there is about 400 million to be redeemed in this year. And then, this year, 400 million to be redeemed. And for next, in 2025, there will be a total of about 1.8 billion of debt to be redeemed. So as per its earnings call, they yes, correct. 400 million in senior notes maturing in Q1 of this year. So this 400 million will be actually be redeemed in the first quarter of 2024. And Netflix actually plan to redeem it via cash on hand. So once it's redeemed, right, it will actually bring down the debt to equity percentage, which is a good thing moving forward. Okay, so in terms of Netflix capital allocation philosophy, they believe they want to only hold about 2 months of revenue in terms of cash on hand. So if you calculate back, this would equate to about 6 billion in cash. So the remaining amount that is past this threshold of 2 months, right, they plan to actually use it to buy back shares, basically repurchase shares to return value to investors, to return excess cash to shareholders. So in terms of how much they're going to buy back or when they're going to buy back, they actually do not have a timeline or amount for it. And then they are just going to look at basically the amount of cash they have in hand, and then from there, see what are their upcoming payables, and whatever remaining over the 2 months of revenue, it will be used to actually repurchase back the shares. Okay, so in terms, besides just looking at debt to equity percentage, if you look at Netflix debt to assets percentage is currently at 29.8%, which is not that high, but then it's not that low also. So it's quite an okay number to actually have moving forward. So basically, it just means that about 30% of Netflix assets are actually funded by debt. So if you look at it as a whole picture, right? If you consider both debt to asset percentage and net to equity percentage, although it may seem high as of now, but as Netflix pays back, redeems its debt, redeems its senior notes, these percentages will actually drop moving forward. Okay, so what can you take away from Netflix financials for FY 2023? So we have seen that its top and bottom line, basically its revenue and profits, has seen impressive growth in the past 5 years. And in terms of margins, it has improved over the past 5 years as well. So in terms of free cash flow, although Netflix plan to use up to 17 billion to buy content assets in 2024, I expect free cash flow to continue being positive moving forward, bar any major upheave to the market or any major upheave to Netflix businesses. And we've also seen that over the past 5 years, US and Canada contributes the most to Netflix earnings in terms of both paid memberships and also number of paid memberships. So consequently, over the past 5 years, we have seen an increasing number of memberships for Netflix, which is a good thing for them because more members means there will be more revenue coming in for Netflix. But although this total number is increasing over the past 5 years, the net increase in memberships, meaning to say new memberships, and after the reduction of people who actually unsubscribe, it has actually not increased that much over the past 5 years. So this is a possible thing to look at if you're looking to invest in Netflix, to actually consider whether its net membership additions will be increasing moving forward or not. And of course, as mentioned earlier, much of Netflix equity is being funded by debt. But then this debt will most likely be repaid in 2024 and 2025. So this portion of equity being funded by debt will actually drop. Okay, so what are Netflix growth drivers and growth inhibitors? Okay, so firstly, I actually split it up into 4 different categories. So first one is definitely Netflix core business, the streaming services industry. And then also Netflix plan to actually skew its advertising revenue over the next few years. So content-wise, since content is the blood of Netflix business, a lot of it how it will grow in the future is very much dependent on how popular Netflix content will be. And also, besides just your films and series and original series, I also look at what are Netflix plans to actually expand into other segments. So let's talk about the streaming industry first. So as you know, Netflix is not the only one that's doing this in the market. Its biggest rival is actually Amazon Prime Video. And then smaller rivals are actually Disney Plus, HBO Max, and also Apple TV. So why I say that Prime Video is the biggest competitor, right? Because in terms of market share, if I don't recall wrongly, they're actually above slightly as compared to Netflix. And then in terms of their subscription plans price, it's also very competitive as compared to Netflix. So I foresee that over the next few years, Amazon Prime Video will be the main competitor to Netflix. Of course, Disney Plus and HBO Max also have their own market share in the market. But then, in terms of scale and content wise, I do not foresee both of these to be a big competitor to Netflix. Actually, as of now, lah. But anything can change in the future, so we just have to continue watching what are the developments in these few competitors. But regardless of competitors, right, if you look at the market as a whole, the streaming industry market, there's still a lot of space to actually grow in the market. Because if you look at this report, over the next, all the way to 2027, it's expected to grow at about, if you average it off, is about 9% per year for the next 3 or 4 years. So even though there are more competitors coming in, there's still a lot of there's still a lot of total addressable market for both Netflix and also its competitors. So yeah, I do not foresee a very big impact to Netflix earnings over the next 3 or 4 years. Okay, so earlier on I talked about Netflix plan to actually start scaling its advertising revenue. So as stated in its earnings call for Q4 of 2023, they actually informed that their ads membership plans increased by 7% quarter on quarter. So meaning to say that their paid ads, their ads membership plan for certain countries has actually seen an uptick in memberships. Okay, so you also informed that ads plan now accounts for 40% of all Netflix sign-ups in our ads market. Okay, so if I look at how big an opportunity for Netflix, how big opportunity for advertising revenue is it for Netflix? Just have to see that outside of China and Russia, there's a 180 billion market to be addressed that is possible to be tapped on by Netflix. And 25 billion alone is on connected TV. So connected TV, in my opinion, is a dying industry because everyone is moving towards streaming nowadays. There's very few individuals that will actually purchase cable TV plans. So this 180 billion market is all for Netflix to actually target in the next few years to come. And currently, for their ads membership plan, it's only available in 12 countries. And then these 12 countries, right, they actually represent 80% of the global ad spend. So in other words, Netflix do not see a need to actually expand this ad membership plan past these 12 countries as of now. Of course, in the future, once it becomes more saturated, they will definitely introduce the plans to other countries and other regions. Okay, so moving on to content popularity and exclusive assets. As we all know, Netflix earnings is heavily based on their subscriber memberships, which also means that it's heavily reliant on consumer experience and behavior. And then as I mentioned earlier, a lot of cash is used upfront to pay for content assets. But then by doing so, there's no certainty that there'll be success for these content assets. And also most of the time, once you purchase these content assets, right, there will be a period of time or a few years, 2 to 3 years for production to take place before Netflix can actually put the be it original series or original film on its streaming platform. Okay, so increasingly, there's a battle for exclusive content across all streaming companies, be it Amazon Prime Video, HBO Max, or Disney Plus. So if you see here, right, each of its own streaming provider has its own sets of so-called exclusive content. So for Amazon Prime, it'll be series like The Boys, Invincible, and also documentary series like All or Nothing. And for HBO side, they also got their own heavyweights in terms of Last of Us, True Detective, and also last but not least, Game of Thrones. So all these are all these things are just exclusive content assets that is unique to each streaming provider. So for Netflix wise, they got a few of their own very successful original series and films. So some of these series includes Narcos, recently the One Piece live action series, Peaky Blinders, Squid Game, Stranger Things, also Money Heist. So films wise, they have their own original films like Red Notice, Extraction, and Bird Box. But then besides that, they also have partnerships with other production houses to actually bring in films from other companies onto their platform. So not only do they have their own original films, but also partnerships with other studios. So all this will actually bring Netflix forward in growth as they come up with more original content that their viewers like, and also have more partnerships to onboard other films from other studios and or even other streaming providers. So besides film content and general series content, Netflix is also moving into games and live streaming spots. Okay, so for live streaming wise, they just recently announced this deal, I think, on Wednesday or Tuesday. They actually have a deal with WWE Raw for about 10 years from 2025 all the way to 2035 at about 500 million per year. So this exclusive content rights give them the rights to actually film, to put WWE content on the Netflix platform. Meaning to say that Netflix can now broadcast live streaming shows like WWE Raw, SmackDown, and their pay-per-view offerings. So besides all these typical typical screen content of films, whatnots, Netflix is also moving into providing mobile games and also PC games in the future. Actually, as of now, they only got a few offerings for their games on their platform, but then most of these games are still, for now, small names as compared to bigger AAA games. Okay, so the question comes to whether should you invest in Netflix or not. So I provided two sides of the coin. So for the fall part, it's basically Netflix remains an industry leader for both streaming and TV content. And then over the past few years, it has shown that its original series and films can have widespread popularity with its viewers and also for new viewers. So this one example you can see is things like Squid Game, the One Piece live action series. It's all garnered very good reviews from their viewers. So in terms of growth runway for Netflix over the next few years, they still got plenty of growth opportunities, be it in advertising, be it in gaming, or potentially even live stream sports entertainment. And look at the past 5 years financial wise, they have also grown their top and bottom line quite impressively over the past 5 years. And in terms of paid memberships, it also increased over the past 5 years. But on the other hand, on the other side of the coin, the against reasons for investing in Netflix is basically that their whole business model, right, is very reliant on consumer behavior. So meaning to say that it's very geared towards customer satisfaction. Meaning to say that to continue coming up with new content or build on existing content that their consumers or their customers will like. So if you look at streaming platforms as a whole, right, a lot of it is down to what the customer wants to watch. So for example, let's say you follow a particular series, let's say series A on maybe HBO Max. So you only sign to HBO Max once there's a new series for the particular content access. So for example, maybe Game of Thrones, you only want to watch Game of Thrones on the HBO Max platform. So if you have no interest in other series or other films, right, it's very unlikely for you to actually sign up for another streaming platform. Okay, so as earlier mentioned, purchase content access, there is no certain success or how well we'll do in the future. So once again, if you bring up the amount of money they spend per year, it's about 12 billion for 2023. And then for 2024, it'll be moving up to 17 billion. So all this cash that is paid up front, there is no guarantee that there's no guarantee the content they come up with will have popularity with their current existing subscribers. So that's one thing to think about whether you want to invest in Netflix or not. And then if you look at their net paid membership addition for the past 5 years, there's not much growth in it. It's only, if I don't recall wrongly, a positive 1% over the past 5 years. And then once again, debt levels also remain quite significant, although it should decrease once Netflix repaid some of its outstanding debt. Okay, last but not least, in terms of valuation, Netflix is not cheap at all. So based on its current market price of $562 on as of Thursday night, it comes out to a P/E ratio of 46.71. And then if you look at forward P/E ratio, right, if you assume that Netflix revenue for 2024 is going to be 36 billion, their diluted EPS will come out to about $14.50. So if you work it backwards, right, it means that their forward P/E ratio will be 38.6 times. So by no means is this a cheap investment to make. Of course, this figure is even higher than companies like Microsoft, even higher than companies like Nvidia, or your big tech companies like Meta, or what other big techs are there? Or Alphabet, which is the parent company of Google. So yeah, so if you're investing in Netflix now, I don't think it's the right price as of now. We want to wait for it to fall to maybe about 350, which will bring your forward PE to be about 25 times. Yeah. Okay, so that's all for Netflix. I'll be moving on to Tesla next. But let me just get a sip of water first. Okay, now on to Tesla. Okay, so if you have not known, there was a big market reaction to Tesla's Q4 earnings. As mentioned earlier, their share price dropped by 12.1%. But let's take a deeper look at its financial results. So we look at automotive segment. They ended Q4 with 21.5 billion in revenue, which was a 1% year-on-year increase as compared to the previous quarter. And then energy generation and storage wise came in at 10% increase. It came in at 1.4 billion, which was a 10% year-on-year increase as compared to the previous quarter of 2022. So in terms of gross revenue wise, gross profits wise, you will see that it's a very big drop. It's a very big year-on-year drop of 23%. And then margins also dropped by about 6% as compared to the previous year. So all this is just a comparison of Q4 2023 to Q4 of 2022. But if you look at the whole year itself, okay, you will see that total revenue has actually increased from 21.5 billion in 2018 to 96.8 billion in 2023. And then in terms of gross profit, operating profit, and net profit, there's also saw increases from 2018 till 2023. You notice that for Tesla, they actually were on negative net profit for 2018 and 2019 and only turned profitable in 2020. So you notice that for 2023 net profit wise, there's two numbers out here. So this number you see, right, of 15 billion, actually inclusive of about 5 billion in provisions for income tax. So if we remove that provision away, it means that their net profit for 2023 is actually at about 10 billion. So in terms of trend, if you look at the past 5 years, compounded annual growth rate for revenue was about 45.7%, and then gross profit was 44.6%. Free cash flow wise, given that they were negative cash flow in 2018, so you consider 2019 to 2023, their 4-year compounded annual growth rate was 62.3%. And then for operating profit and net profit, since they were negative in 2019 and 2018, if you consider for 2020 onwards, in 3 years, the operating profit compounded annual growth rate was about 111.2%. Or net profit was about 316%. If you include provision of 5 billion, if you exclude that, then it's about 240.1% of compounded annual growth rate over the past 3 years. So in terms of revenue segments wise, they are actually split into 4 main segments. So automotive sales and regulatory credits is basically the sales of EVs, and the automotive leasing is more towards their EV rental business. So you can see that a majority of their revenue for 2023 comes from automotive sales, and then the second most was services and others. Services and others, right? It includes FSD, their full self-driving autonomous software, and also paid supercharger services, and also warranty and selling price of used Tesla. So energy storage and generation came in at 6.2% for 2023. So over the past few years, if you look at the past 5 years, right, you notice that there was a growth rate in both the services and energy storage and generation segments. So 5 years basis for compounded annual growth rate, the automotive sales came in at 46.1% increase over the past 5 years, and the automotive leasing was 24.5%, and energy storage was 40.1%. Services came in at 56.4% compounded annual growth rate over the past 5 years. So in terms of deliveries and production wise, so in 2023, Tesla actually produced 1.8 billion, no wait, 1.8 million vehicles and delivered 1.8 million vehicles. So year on year wise, it's a 35% increase for production and then 38% increase for deliveries. And if you look at storage deployment wise for its energy segment, it was a 125% increase year on year. And then supercharger also increased. So supercharger installations and stations also increased at 27% and 29%. Okay, so let's go down to the. Oh yes, so in the earnings call for Tesla, it actually guided for, they actually mentioned that growth rate for 2024, they foresee to be actually lower than the growth rate achieved in 2023. So much of it is down to their production ramp of a next-gen vehicle. So this vehicle is basically like 25K entry-level vehicle, which will be available for production starting from first half of 2025. So in terms of growth rate wise for this year, much of it will actually be down to the energy business instead of its more prominent automotive business. So we break down Tesla's revenue into its geographical segment. You will find that, okay, so for 2023, they haven't released for the full year yet. So these numbers, this contribution rate is based on the 9 months ended September of 2023. So over the past 5 years, you will see that majority of their revenue comes from US and Canada, and then China and others. So others is basically other parts of the world. And then China, so if we look at all three segments, right? China's contribution is the lowest at 21.8%, which is still quite high actually. So in terms of trend wise, so I did took 4 years trend from 2018 to 2022. So we'll see that China actually contributed, their growth rate was more than 100% for the past 4 years. But then if you look at it as a whole, all segments actually recorded positive growth rate over the past 4 years. Okay, so in terms of margins wise, this is where I think much of the negative market sentiment actually came from. You will see that its margins actually dropped by quite a bit in 2023. From 25.6% of gross margin in 2022 to 18.2% in 2023. And then for net margin wise, if you exclude the provision for income tax, their margin for their net margin for 2023 is at 10.3%. So much of this margin drop, right, is due to the closure of Tesla's factories in 2023. So this one is due to certain upgrades in their production process. So they actually closed some of the factories in 2023 to improve their vehicle production process. So this already has passed. So they are now in full operation for 2024, except for Berlin, which I think is affected due to the Red Sea shipping crisis. So beside factory closures in 2023, there were also price cuts in 2023, which affected the upfront revenues of Tesla EVs. Okay, so as you can see, if I don't recall wrongly, there were a total of 6 price cuts in 2023 for Tesla vehicles across its various models like Model 3 and Model Y. So all this actually put pressure on the revenue that is gained from each EV that is sold, leading to lower gross margin, which consequently leads to lower operating and net margins. Okay, so the breakdown of margins, the gross margins into the 3 different segments of Tesla's revenue, you will see the automotive margins drop by close to about 10 basis points, 10%, 10 basis points drop. But then if you look at energy storage and services wise, their margins actually improve as compared to 2022. So yeah, this is why the market reacted so badly to Tesla's Q4 earnings because of this big drop in automotive margins. Okay, so in terms of expenses wise, you will see that over the past 5 years, Tesla's cost of revenue actually increased quite drastically from 17.4 billion to 79.1 billion in 2023. Operating expenses wise has not increased that much, thankfully. So much of this is down to their staff costs and R&D. So in terms of trend wise, you will see the cost of revenue has increased by about 46%, and then operating expenses increased by 18.6%. So you break down the costs of revenue segments, much of it is down to this automotive sales segment, which means the production of EVs. Leasing also came in. Leasing is quite a small contributor, and then much of it also down to FSD and also paid supercharger. So if you look at it as a whole, you'll notice that over the past 5 years, the one that gained the most is automotive sales, which is the EV production process. So this is not surprising, because if you look at Tesla's production numbers, the more vehicles they produce, the more cost they actually incur. But then if you look into their individual EVs, right, according to Tesla, their cost of revenue, basically cost of goods sold per vehicle, actually dropped from Q4 of 2022 at about $39,000 to $36,500 per EV sold. So much of this increase is due to its production numbers scaling up, not so much of increased material costs or other costs, because this in fact actually decreased over the past few years. Okay, so if you look at operating expenses wise, much of it is down to their back end and corporate staff, and then also R&D. So not much to talk about here. Just to give you a quick illustration of what its operating expenses segments are. So trend wise, 14% increase in staff costs, and then R&D increased by 28.4%. So R&D, much of it is due to Tesla's foray into AI and robotics. So there's a lot of upfront R&D that's needed for these two emerging segments on top of their energy business and EV business. Okay, so look at financial metrics wise, Tesla remains financially healthy with a current ratio of 1.73 times for 2023, which was an increase from 1.53 in 2022. Debt-wise also came in quite healthily at about 8.4% of equity in 2023. So financials-wise, in terms of financial health, Tesla should have no issues moving forward. Okay, so in terms of free cash flow and capex costs, right, you'll notice that from 2018 to 2022, free cash flow actually increased quite steadily over the last 4 years. It's only for this year that free cash flow dropped by quite a bit to 4.4 billion in 2023. So much of it is down to the price cuts, and also mostly down to the price cuts, and also Tesla's investment in AI and robotics. So you can also see an uptick in capital expenditure for 2023. So for 2024, first of all, 2024, this number is actually increased during the earnings call. The management team actually informed that this number actually increased to about 10 billion in 2024. So since 2024, so earlier on, since production of 2024 EVs actually slowed down, this will mean that free cash flow for 2024 would most likely be lower than this 4.4 figure due to expected slowdown in production of current EVs. So what can you take away from Tesla's financial earnings? Okay, so we have seen that in terms of top and bottom line results, the price cuts, factory closures, and also the fall in EV demand has affected both Tesla earnings and revenue. However, their cost of revenue sold per EV has actually decreased, and also material costs has also decreased for per EV. So I mentioned earlier on, free cash flow for 2024 most likely decreased due to increased capex and expected lower average selling price per EV in 2024. But nevertheless, Tesla remains a healthy financial position moving into 2024. So yeah, if we move on to Tesla's growth inhibitors and drivers for the next few years, I'll touch on the inhibitors first. So first one, currently in the market now there's multiple competitors in the market from both Chinese automakers and also more traditional and Western automakers like Volkswagen, GM, Stellantis. So the biggest competitor in my opinion is BYD for Tesla because they recently surpassed Tesla for the number of EVs sold in the fourth quarter of 2023. And also in his recent earnings call, Elon Musk actually did also mention that Chinese EV makers will actually demolish other automakers in the race for market share in the EV space. Okay, but although this may seem very bearish, there's a very big issue when it comes to Chinese EV makers. Basically, it's down to how the Western world perceives them. Because you have seen that for both US, or for US, they actually impose tariffs on Chinese automakers of up to 25% levy, meaning to say that there will be a levy on top of the price of bringing the EV to the US from China. So for China to actually expand for Chinese EV makers to actually expand their footprint, they have to actually penetrate both the US market and the Europe market. But then both of these markets are actually wary of actually accepting all these Chinese EVs. So that is why for now, I do not foresee them having much success in moving into the Western market, which is also quite good news for Tesla because they're already established in both of these Western markets. Okay, so although there are more EV competitors, right? The EV industry as a whole is still expected to increase over the next year or so. So there is still a space for Tesla to grow in 2024. Because as you can see that total EV sales for both battery electrics and plug-in hybrids will increase by about 21% in 2024. So much of this growth will come from China, which unfortunately Tesla is losing out the fight in China market to the Chinese EV makers, mainly BYD. So this one I don't see much room for Tesla to grow in China, but rather in the other parts of the world, like Europe, Asia Pacific, and also US and Canada. Okay, so as you can see in Tesla's market share, right, there are still only 4% of market share in US, Canada, and about 3% in Europe, and about 2% plus in China. So look at it as a whole, there's still a lot of room for Tesla to grow and capture market share in all these major markets. But the one thing to note is that, as you can see from the trend line, you will see plateauing out in the recent past few quarters. So maybe this is the reason So why is this so? Because of there is a fall in demand for EV as of now due to certain reasons. One of it being there are still concerns of how the range of EVs, like how much miles they can travel before the battery dies. And then also, as of now, there is still limited charging infrastructure across the whole world. So for EV to actually take off, right, they need to have the necessary charging infrastructure in place before people can actually consider buying EVs in the market. So last but not least, the current interest rate environment is also not a good environment for people to buy EVs. So mainly this is down to the fact that most people actually use car loans or vehicle loans to actually buy EVs. So if interest rates are high, it means that there's lesser demand for people to take on car loans on top of their own mortgage loans and whatnots to purchase a thing that is not a need in their daily life. So this is why for 2023 as a whole, EV demand was so weak in that sense due to all these reasons. Maybe also due to this. So besides the weak EV demand, there's also certain challenges that Tesla face, mainly down to its own FSD software. So if you do not know, the DOJ of US actually issued subpoenas to Tesla its ongoing probes on its FSD claims. So this is still not resolved as of now. So we do not know what's the outcome of all these regulatory probes. And besides FSD, there are also certain issues like steering and whatnots that could lead to Tesla recalling vehicles. So in 2023, Tesla recalled a few vehicles due to certain issues like steering and door latch controls. So in 2024, this year, Tesla actually recalled more than 1.6 million vehicles in China due to problems with their automatic steering and also door latch controls. Okay, so all these three are actually growth inhibitors. In terms of drivers for Tesla, there's actually quite a few growth drivers for Tesla moving forward. Okay, so firstly, let me touch on Tesla's plans to produce an entry-level EV. So this entry-level EV is codenamed Redwood and it's expected to actually go into production in mid-2025. So meaning you only see the effects on its financials, on Tesla financials in third quarter of 2025 onwards. So yeah, this is one, to me, this is the main thing that Tesla needs to actually continue growing in the next few years. Well, after all, cars itself, they are actually a big ticket item. So price of EVs really matters when it comes to consumers buying new EVs. Okay, so besides just the entry-level EVs coming to production in mid-2025, Tesla also can benefit from the global transition to sustainable energy. So the recently concluded COP28 meeting, countries actually agreed a deal to reduce consumption of fossil fuels. So this will mean that there will most likely be heightened demand in sustainable energy solutions, which will benefit Tesla in its energy generation and storage revenue segment. But of course, all these things needs to come with government action and also action for corporations to actually take on the transition to sustainable energy. Okay, so in terms of the renewable industry, renewable power industry growth for the next 5 years, it's expected to grow by about 2,400 gigawatts over the next 5 years. So this means that there will be ample room of opportunity for Tesla to actually grow its energy segment over the next 5 years. And then renewable energy also account to take over 90% of global electricity expansion over the next 5 years, which means that there will be a huge demand for sustainable energy solutions moving forward. So besides the entry-level EVs and the demand for renewable energy, there could be further advancements in FSD and Optimus board. So in its earnings call for fourth quarter 2023, Tesla actually informed that they roll out version 12 FSD beta to certain Tesla employees. Okay, so in terms of driving automation wise, in terms of advancement wise, we are still currently in between, somewhere between 2 and 3, which means that there will still be much human intervention needed in terms of there will still be human intervention needed in certain decisions that the car makes. So the ultimate aim for automation for autonomous driving, right, is definitely level 5. But currently we are still very far away from reaching this level 5 automation. When will we reach it? I have no idea. It could be 5 years, it could be 10 years, no one really knows. It all depends on the current advancement in technology. And much of it is down to AI also, because AI can actually accelerate the rate of learning for autonomous driving. So besides AI, Tesla also is doing investments into making a humanoid robot. So there are plans actually for this robot to actually take over manual physical tasks in factory manufacturing. So all this advancement in FSD and Optimus, right, to me, it will not provide any upside, will not provide much upside to Tesla's current earnings, be it in this year or the next. This is more towards the future, in maybe 5 to 10 years. So yeah, so we're thinking of incremental advancements in Tesla's financials due to FSD and Optimus. Sadly, I don't think there will be much impact financially for Tesla in the next 1 or 2 years. Okay, so the question of should we invest in Tesla? Should we invest in Tesla or not? Okay, so once again, there's both sides of the coin. So for the foresight, Tesla still remains one of the top EV makers in the industry. So currently they're only behind BYD in terms of production numbers. And they still remain one of the few EV companies to actually produce vehicles, to actually produce EVs with margins that are higher than industry average. Okay, so for Tesla wise, their growth is situated in 2 growing industries: sustainable energy and also EVs. And over the past 5 years, their financial numbers have also grown at a rather healthy pace, and they also remain financially healthy. And then in terms of Optimus and FSD, any advancements in AI robotics could open up new revenue segments in the next maybe 5 years or 10 years time. So this one is still very it's not a very clear advantage or clear way for Tesla to actually monetize this thing yet. Of course, FSD, they have already monetized it in terms of growing their services and other segments. So for the against side, actually quite a few. So demand for EVs has dropped due to the current high interest rate environment. And then there are also issues using EVs in very cold weather. So there are a few studies that have shown that for EVs in cold weathers, right, their range, which is the number of miles they can travel, actually drop in very cold weathers by about 10%. So this is a consideration for those living in countries like US, Canada, and Europe, where they actually experience the winter season. So Tesla itself, as a company, remains a cyclical sector, meaning to say that their revenue comes from consumer discretionary spending, and it's not a need for anyone to buy an EV. It's not a need for anyone to buy an EV. And then in terms of the EV industry, there's a number of very high-profile competitors like your BYD, like your XPeng, or even the European automakers like Volkswagen and whatnots. So because of this competition for EVs for other EV companies, there's a possibility that Tesla has to make further price cuts to their current EV fleet to actually try to spur people to actually buy Tesla EVs. So this will also impact their gross margin for this year and the next. So yeah, one to look out for. Okay, so besides the potential of price cuts, they actually informed in the earnings call for Q4 2023 that in 2024 there will be a slowdown in production for EVs as they are ramping up production for the next gen entry level EV, which will be mass produced in mid 2025. So of course, if you invest in Tesla, you're actually prone to Elon Musk controversy, because this guy, he just can't keep his mouth shut. So yeah, if you look at the news, there's multiple times when he has actually said a lot of things that might affect how individuals view Tesla as. So be it if it's a comments of increasing or wanting a more increased stake in Tesla or whatnot. So whatever he says has a impact on how attractive Tesla is as a brand. Okay, so last but not least, Tesla valuation is one of the highest in the market. Oops, where is my mouse? Okay, let me just see. Wait, hold on for a while. Okay, so we look at Tesla valuation wise, in terms of its current market price of 182.63, its P ratio comes in at 42.46 times, which is quite high. And if we assume that Tesla's 2024 EPS is going to be $3.40, it will mean that its forward P ratio will be 53.7 times, which remains very high. So by traditional metrics of valuation, Tesla is not cheap at all, even after its price has come down by about 12% from its price before earnings call. So for myself, I'm a Tesla shareholder. So just want to end this live with these few things to note if you are a fellow shareholder. Let's reevaluate your reasons for investing in Tesla. Because let's reevaluate your reasons whether it's still valid or not with its recent release of its 2023 results. So for myself, I still think my reasons for investing in Tesla remains valid because I invested due to its high industry margins and also its growth in both the EV segment and also the energy segment. So although 2023 results were bad, but then they still remain positive for now. So of course, if you are a fellow shareholder, do your own research instead of relying on market news or other individuals. So a lot of times I've seen that when it comes to Tesla, be it positive or negative news, it brings a very big market reaction. But many of times, these news or whatnots, right, they are more like noise instead of actual news. Because you must know that news in the market is based on how popular it's all to get eyeballs, in a sense, or get attention and to get more attention. So the more sensationalized the news is, the more attention you'll get. So be it whether Tesla is doing well or not, there will always be good and bad news to it. So of course, when it comes to investing, if you think long term, long term meaning 5 years or more, to see where you foresee Tesla will be the next 5 to 10 years. So of course, if your conviction remains, you can always buy at the specific dips at crucial support levels. And of course, last but not least, be humble and also do not fall in love with your stock lah. So yeah, always evaluate it objectively and see whether it aligns with your reasons for investing in a company or not. So yeah, with that, I'll end this live. So thank you for watching, and I will see you all in next week's live. I will touch on most likely on REITs. Yeah, see you. Bye bye.